Hey YouTube, welcome back to Shaysky TV. I hope you guys are having a great day. It is December 2020, and if you guys are like me who want a fresh start in 2021, in this video I'm going to introduce you 3 stocks that I personally think that'll have a great investment return in 2021. Let's get started. The first stock that I recommend buying in 2021 is called NextEra Energy, ticker symbol NEE, and I have been personally holding this stock since 2017 and I will continue to buy more in 2021. If you guys haven't heard of this company before, it is an electric utility company that emphasizes on clean energy, specifically wind and solar energy. They're actually the world's largest producer of wind and solar energy, and they're currently ranked 3rd in terms of customers in the United States. They operate subsidiary companies including Florida Power and Light, Gulf Power, NextEra Resources, NextEra Partners, and they have assets operated both in US and Canada. I think this is a good pick because this is a growth company providing a lot of long-term value. They have a solid history of stock performance, revenue growth, earnings growth, dividend growth, plus the fact that the management team is consistently making good decisions. On stock fundamentals, their PE, price to earnings ratio, is trading at 37, which is exactly the same as S&P 500's PE ratio of 37. Their price to sales ratio is 7.9, which is much higher than the S&P ratio of 2.66, but this is mostly due to the recent decline caused by the pandemic. Their price to book ratio is 3.43, where the S&P is at 4.05, and this is because NextEra has a lot of assets relative to liabilities. If we just look at these price ratios, it tells me that NextEra stock is fairly aligned with the average company in the S&P 500 and is priced at a good value. Something I really like about this stock is that it pays an annual dividend of 2% that's paid out every quarter. You can think of it as if you invest $100 into this stock, you get $2 back every year just for being a shareholder in this company. This is also a low-risk investment. In the United States, utilities are regulated in some states. For example, in Georgia, where I'm living now, my only choice of utility for my apartment is Georgia Power, and this is because regulations prevent competitors from entering this market. You can think of it as NextEra has somewhat of a monopoly effect for the regulated states it's currently operating in. That means the barrier of entry is high and it prevents competitors from entering the market and taking a piece of the pie. NextEra is currently the largest rate-regulated electric utility in the United States as measured by retail electricity produced and sold. If you feel like you've missed out on stocks like Tesla or the Chinese Teslas but still want to participate somehow, NextEra is actually the best out of both worlds because at this point we're fairly certain that clean energy is the future and electric vehicles represent a big part of that future. But with this much speculation going on, it's hard to say how much of Tesla's stock is going to go up and how much of it is going to go down. But what we're certain of is that NextEra produces this electricity that these electric vehicles needs to run on. There are a lot of online articles saying that NextEra is a Tesla of utilities, that Tesla might acquire NextEra, or these two companies should merge together. These are just speculations, but unlike Tesla stock that has a PE ratio of over 1,000, NextEra is much more fairly priced at 37. So 15% of my portfolio is in NextEra, and I will continue to buy more in 2021. If you guys are still watching this video, hit the like button and subscribe to my channel for more contents like this. With that said, let's jump to the next stock. The second stock that I think is a good buy in 2021 is Visa, ticker symbol V, and this stock has been performing relatively close with the S&P 500 and is up around 8% year to date. I think this is reasonable performance because it's one of the companies that are affected by the pandemic. As places are being shut down and people are doing less traveling and credit card spending reduces, and so does Visa's revenue. But because of this, I think this is an excellent opportunity to get in because in their latest earnings call, Visa expects to see improved results in the final quarter of 2020. Thinking about long-term value, as people are sitting at home right now during this pandemic period, they're somewhat forced to buy stuff online and transition from using cash to using credit cards. Visa has the highest credit card market share in the United States, so it benefits tremendously in terms of brand value. Currently, Visa is one of Forbes' top 20 most valuable global brands in 2020, so this is a very good pick if you want to diversify your portfolio. The economy outlook in 2021 has been positive. Goldman Sachs anticipates that the US GDP will go back to pre-pandemic levels under the Biden presidency and as the vaccine progress continues. The government is also very likely to pass another round of $1 trillion stimulus stimulation money to boost the economy, and this is very good news for companies like Visa because their revenue is strongly dependent on the economy. In the long term, the economy is sure to grow as things slowly go back to normal, but in the short term, this is an excellent opportunity to get in because the stock price is not too expensive at this point. Visa's price-to-earnings ratio is trading at 47, which is higher than the S&P 500. Their short-term price-to-sales ratio is 23.57, which is much higher than the S&P, but the sales decline is also affected by the pandemic. Their price-to-book ratio is 11, which is reasonable for a credit card service company. If we just look at these price ratios, I think it's priced very reasonable for a company in this industry. Last but not least is Disney. This is another company that has been hit pretty hard by the pandemic as parks are being closed and money is going down the drain, but it keeps hitting all-time highs recently. Why is this? Well, first of all, on Investors Day that happened this week, they unloaded a bunch of impressive Disney Plus announcements plus a price hike. The Disney Plus platform now has 86.8 million subscribers. Remember, Disney Plus's launch date was back in November 2019, the same year where Disney took their contents off Netflix, and in just 1 year, they achieved over 80 million subscribers, and that is incredible. They also expect this number to grow into 2024, where they expect between 230 to 260 million of subscribers. Not only that, but Disney also have Hulu, ESPN, National Geographic, and other channels, each of which has double digits millions of subscribers. Disney parks are just one area of the business, and film entertainment content is another. Since customers drive long-term profitability, and with this much subscribers that they announced, their stock has been on a rocket lately. Disney is now a very diversified, pandemic-proof business, and what has impressed me the most is the management team's strategic decisions. In the past, they include buying Marvel in 2009 for $4 billion, and a decade later, it has made more than $18 billion, and this is because the company knows how to leverage their distinct core competency. They also removed their contents from Netflix to host their own subscription services, which was an excellent decision because that's money raining down right there. What's exciting is that in 2021, Disney announced that it will release 17 new films on HBO Max and also in theaters. Although there are some uncertainties around the in-person theaters, Disney is still producing new content and staying ahead in innovation. Disney is also in Forbes' top 20 most valuable global brands in 2020, and I keep mentioning about brand name because that's extremely important in a time like this. You'll notice that small businesses suffer the most because they have limited capital, they're not very diversified, and they have to spend a lot of energy to regain the customers back after the pandemic is over, and this is because customers are more easily to forget a company with a low brand name. But Disney, however, people won't forget and they will rush back to the Disney parks after this pandemic is over. In stock fundamentals, Disney had a negative earnings last quarter, so it doesn't have a PE ratio at the moment. Before the pandemic hit, it was trading in the 30s when it was near all-time high. So if I'm buying this stock, logically, I am expecting Disney to restore their earnings to pre-pandemic levels. The price-to-sales ratio is 4.29, which is higher than the S&P but not too concerning. Their price-to-book ratio is 3.12, which makes sense because they have a lot of assets. If I'm confident that they can reach pre-pandemic earnings and continue to grow their earnings through their subscribers and new contents, then I believe this is a fairly priced stock, if not undervalued. In summary, I think Disney stock is fairly priced. The company has good diversification, strong brand image, growing customer base, and a solid management team. This is why I think Disney is a low-risk investment, and I think their business is going to continue to grow and their stock price will continue to go up in the long term. I also think the entertainment industry will thrive in the next decade as people have more time on their hands due to technology making people's life easier. And this industry also got a nice boost in their bottom line from this pandemic, so it's a very good opportunity to get in. I will be buying Disney in 2021 and I will be holding this stock for the long term. In terms of execution, I'm going to divide my capital and dollar cost average into the stock because it's been pretty volatile in the past year and it's been hitting all-time highs recently. So I'll be buying some shares in January and then again in February and March and so on instead of just making a one-time purchase. So the 3 stocks that I mentioned in this video all pay a dividend, and some of it might be a small percent of dividend, but if you guys are like me who is a long-term investor, turn that dividend to auto reinvest and let it snowball and compound into an even bigger amount in the future. I hope you guys enjoyed watching this video. If you did, hit the like button and subscribe to my channel for more related contents on investing and personal finance. Let me know in the comments below what you think of these 3 stocks and what stocks are you investing in 2021. Be sure to also check out my other videos in my channel and have a fantastic rest of 2020 and a great start in 2021. Cheers!